traditional syndication, let's say 30% of the overall equity in the deal goes to the general partners. That's the operating partners. 70% usually goes to listen, I just learned this like 2 years ago because I've never structured a deal this way. And so 70% of the equity goes to the equity investors. So that's people actually downstroking the check for the down payment and operating capital. Out of that 30%, for the GP, the general partners, that gets carved up amongst who found the deal, who sponsored the loan, who helped raise the capital, who's operating the project management, the property management, boots on the ground, all those different elements come out of the GP portion. Mm-hmm. The LPs, the limited partners, the passive investors who have 70% of the deal, they essentially have, they passively invest, and then they get a certain percentage. They get 70% of all the cash flows, of all the refi proceeds, and all those different things. Now, they typically only get paid if the property's performing. Mm-hmm. So if the property's cash flowing, that's a great deal for them. If it's not cash flowing, they might be sitting on an investment in this project for a year, 3 years, 5 years before they see any return on their investment. But they get 70% of the deal, which could be advantageous, 70% of the depreciation, all those things. Mm-hmm. The operating partners, the GPs, might only have 30%, but they can charge acquisition fees and asset management fees and other different sponsorship fees and fundraising fees. I've seen a bunch of fees come off the table on that. And again, it depends on the deal, and the equity can change and vary and stuff. So that's traditional syndication. It's usually a 5-year to 10-year hold, and they buy it at pretty close to a retail price. Maybe there's some value add. Maybe you can bump rents over time, and after 10 years, you pay down enough principal and the property appreciated where now you can sell it and make a bunch of money. But you just add value. You add value to people. You add value in educating them. Mm-hmm. Like you're adding a ton of value to your followers and your listeners by having this podcast, by bringing on guests and sharing knowledge about how to build wealth and how to build lifestyle and tax advantages and all those different amazing things. You are going to, derive private money and deal flow and all those different things from having your own podcast. Now I'm one of 4 kids, and my dad was a police officer, also had like a side business that did personnel security for hospitals and apartment buildings actually. And then my mom was stay-at-home mom. And so she had a teaching degree and volunteered full-time. So those are my parents, as all-American as you can get, I guess, a cop and a teacher. Mm-hmm. And then I'm one of 3 kids. I have 2 older brothers and a younger sister. And my older brothers are 5 and 7 years senior to me. They pick on me a whole bunch, put me in headlocks, give me noogies, all that stuff. And my little sister and I were real close growing up. And then she hit puberty and she was like psycho, right? So no, but our dinner table was, we all played sports. It was kind of chaotic and crazy with practices and games and all that stuff. But I think my parents did a pretty good job of getting us all together. And it didn't matter how much food was at the table. We would all just a bunch of ravenous dogs coming from basketball, baseball, and football and soccer practice and eat it all. But one of the questions my mom always asked at the dinner table was, "What did you learn today?" And I think she instilled one of those seeds in me of always be learning, right? Mm-hmm. Doesn't matter what you have going on, like always be learning, a lifetime learner type thing. And that's something that I still subscribe to today, where I'm always trying to learn new things because, but not only learn it, but knowledge is power and actually putting it to use. Put it to use. Doing some good things with it. So exactly. I'm a big believer in constant and never-ending improvement.
Yeah, no, I love it. I love it. So were you an entrepreneurial kid growing up? Were you the one slinging candy or anything like that? Or did you have any kind of like side things going on when you were growing up?
I don't really remember. So my dad told me a story just like a couple of weeks ago that I used to take baseball cards and go to him and say, "Hey Dad, I'll trade you, I want your 3 baseball cards and I'll give you this one guy that nobody's ever heard of." And I try to like wheel and deal with him. And he would just be like, "All right, I'll tell you what. Don't trade. You hold on to that one, and I'll give you these 3, and then we'll if I ever need that one, I'll come and get it from you." So he kind of helped with that. As far as like entrepreneurial, I can't remember anything really entrepreneurial until I hit high school. I used to cut my own hair, and so I remember going on vacation in like whatever middle school, and I needed a haircut, and I couldn't, so I grabbed my brother's clippers and I cut my own hair, and then I never paid for a haircut. Now I don't even need haircuts. Right? So So I've never paid for a haircut after whatever it was when I was 12 years old. And my buddies would all come to me and ask me to cut their hair. So I used to cut their hair, and they'd kick me $5-10
Mm-hmm.
in order to cut their hair. And then the other thing that I did was back in the days of like Napster and Audio Galaxy and like all these ways to rip digital music. I used to illegally download music and then create like mix CDs for
Mm-hmm.
people and then sell them to them. And so that's how I wheeled and dealed and made some money in high school. And then it kind of, turned into, I had a painting company in
Mm-hmm.
college. And then I interned for a big real estate builder, home builder, one of the biggest in the country. And that's how I got involved in like real estate. And I realized how much money there was in real estate in 2006 and was like, I'm getting involved in real estate. So when I graduated from college, that's when I moved out to New York City. I'm from Cleveland, Ohio originally,
Mm-hmm.
and moved out to New York and got a job as a real estate agent in commercial real estate. So that's what got me into real estate, man.
So that's how you kind of got your first steps into commercial real estate. When did you really make the jump in yourself into commercial real estate? Obviously you're doing it, that was your job, but when did you start investing yourself into commercial?
So I bought my first property, which was residential though. It was a duplex in 2009, April 2009.
Mm-hmm.
And I realized I wanted to become an investor. First, I kind of knew, hey, we all have this allure of residual income and passive income and this mailbox money that we all hear about. But then we all think we have to go and trade our time for money and do the transactional thing in order to stockpile our own cash to then go and invest in these passive income producing assets. And for me, that's what I did. I went and got my real estate license. And then I realized pretty quickly that I need to be owning real estate, not brokering it.
Mm-hmm.
And I moved down to Charleston, South Carolina, which is where I'm coming to you from right now. And in Charleston, I found, this is 2008 now, and right as I go through this analysis paralysis, the market crashes.
Mm-hmm.
And everybody says, run from real estate. Nobody's investing in real estate, especially with a punk 23-year-old kid who's never done a deal before. And so I actually got it raised on my credit card, and I called up my credit card company, got them to increase my limit, and I bought the cheapest house in the entire MLS on my credit card.
Wow.
So fixed up this duplex personally, did all the work to it, put it back on the market, and just for sale by my owner, and canvas neighborhoods with flyers and bandit signs and all that. Held an open house, and one of the neighbors came in and paid me $33,000 for it. I was all in for $19,000, and
Mm-hmm.
I made $14,000. And so that was my first deal. Soon thereafter, within a couple months thereafter, I bought my first buy and hold deal.
Mm-hmm.
And this is kind of what planted the seed of how I structure my deals today. So I ended up finding a property from a seller. They needed some cash, but didn't need all their cash. And I was buying a duplex for $50,000, fully occupied, $550 in rent on the front end, in the front house, $550 in rent on the back house. So it was generating $1,100 a month in cash. And I went in, got the seller to hold back a note for $32,000. I raised
Mm-hmm.
private money for $25,000. And so I had $57,000 of essentially private money. And I was able to go in and take over that deal with no money out of my own pocket,
Mm-hmm.
walked away from closing with a $7,000 check, and had a property that was cash flowing after everything around $400 or $500 a month.
Mm-hmm.
And so I'm like, now I realize I didn't have to use my own money in order to go out and buy real estate. I could partner with private money investors and structure it that way. So that's what kind of culminated that. I, doubled down on that aspect for a couple of years. And in 2012, ended up buying my first apartment building. And it was, this is like total, basement, bottom of the barrel pricing now.
Mm-hmm.
And I bought an 8-unit apartment building in Cleveland, Ohio, West 130th and I-480, right over there.
Okay. Yep.
Brook Road area, just north of Brook Park and I-480. And bought an 8-unit apartment building over there. 3 units were already occupied. I was bringing in around $1,000 a month in rent. And I bought it for $30,000.
Wow.
So
wow.
I ended up, renovating it, put 50 grand into it, got it fully occupied, and it was generating somewhere around $3,500 a month in rent. So it's about $42,000 a year. I was self-managing it. I was netting around $27,000 a year, and ended up, it was a 33% cap rate at my cost basis.
Yeah. Wow. Wow.
And then just parlayed that into more and more and more properties, bigger properties, another 8 unit, a 14 unit, and just organically grew my portfolio to about 140 units. And then at my partnership that I had with 140 units we decided to dissolve everything and liquidate everything.
Mm-hmm.
So I had to sell those, but as I did that, I kind of built up a few more units and got myself back up to a couple hundred units, which allowed me to go and, buy a 100-unit apartment building. And then
Mm-hmm.
I bought, a 400-unit apartment building, and just kind of, again, organically grew that. I never had a co-sponsor on a deal, and
Wow.
never knew how to do that. And so I just, organically grew my portfolio personally.
Mm-hmm.
And I never traditionally syndicated. I've never taken a syndication class. I've never read a book on syndication. I just utilized single family practices and equations and how I structure things on single family. And I did the exact same thing with the multifamily side. So I structure my syndications very differently than traditional syndication structure.
Yeah, you do. Can you talk a little bit about what you do differently than what typical syndication deals are structured?
Does everybody know, do most of your listeners know how a traditional syndication is structured?
Yeah. I mean, well, I guess do like a 30-second overview of.
So traditional syndication, let's say 30% of the overall equity in the deal goes to the general partners. That's the operating partners. 70% usually goes to listen, I just learned this like 2 years ago because I've never structured a deal this way. And so 70% of the equity goes to the equity investors. So that's the people actually downstroking the check for the down payment and operating capital. Out of that 30%, for the GP, the general partners, that gets carved up amongst who found the deal, who sponsored the loan, who helped raise the capital, who's operating the project management, the property management, boots on the ground. All those different elements come out of the GP portion.
Mm-hmm.
The LPs, the limited partners, the passive investors who have 70% of the deal, they essentially have they passively invest, and then they get a certain percentage. They get 70% of all the cash flows, of all the refi proceeds, and all those different things. Now, they typically only get paid if the property's performing.
Mm-hmm.
So if the property's cash flowing, that's a great deal for them. If it's not cash flowing, they might be sitting on an investment in this project for a year, 3 years, 5 years before they see any return on their investment. But they get 70% of the deal, which could be advantageous, 70% of the depreciation, all those things.
Mm-hmm.
The operating partners, the GPs, might only have 30%, but they can charge acquisition fees and asset management fees and other different sponsorship fees and fundraising fees. I've seen a bunch of fees come off the table on that. And again, it depends on the deal, and the equity can change and vary and stuff. So that's traditional syndication. It's usually a 5-year to 10-year hold, and they buy it at pretty close to a retail price. Maybe there's some value add. Maybe you can bump rents over time, and after 10 years, you pay down enough principal and the property appreciated where now you can sell it and make a bunch of money. So that's good.
Mm-hmm.
For me, I come from residential real estate. And residential real estate, when you're flipping houses, the equation is you got to be all in for 65% of that after repair value. So if I'm going to buy a house and it's going to be worth $100,000, I need to be all in purchase price, renovation price, and holding costs for around $65,000. I took that same formula and parlayed it into commercial real estate. So instead of, you're just adding some zeros, an apartment building that's worth $10 million, I need to be all in for $6.5 million.
Mm-hmm.
So typically what I buy is decently distressed, right? It's so distressed that the small guys can't qualify for it, and it's so distressed that the big guys don't want it.
Yeah.
So I've kind of found this niche where we're really good at project management. We're really good at repositioning assets that are 50, 60% occupied with terrible management and haven't been had any CapEx done in the past decade or two. And so we're able to come in there, get a great deal on the acquisition price. We do an overhaul of the building, make them clean, safe, functional, cosmetically updated. And then we put good management, good tenants in place, totally lease this thing up, totally reposition it, rebrand it. And we because we've done so much work in a pretty consolidated amount of time, it forces a significant amount of appreciation in a relatively short amount of time. So we're able to hit those numbers in 12 to 24 months on average. So all of a sudden we're all into this $6.5 million deal, and it's worth $10 million in 18 months down the road. That allows us to then turn around and refinance into long-term debt at that time let's call it a 70% LTV loan. So 70% mortgage allows me to then pay off a short-term acquisition loan of, let's say that's $5 million of the deal. And $1.5 million of my $6.5 million all in was private money investors. And then there's some refi proceeds as well. So that new refi loan allows me to pay back all my investors, pay off the short-term loan, carve up some refi proceeds, and then I don't owe anybody any money. So all the chips are off the table. It's only house money in play, and I can hold this thing for 5 years, 10 years, 30 years, 50 years if I wanted to, because I don't owe anybody any money anymore. So there's some advantages to it, but there's also a lot of work that goes into it. So the way that we structure, and I just kind of, again, fell into this, is that I'll buy a deal, and because it's very predictable what my investors' pref payment would be, I can make them a fixed pref payment. So I pay, let's say I pay my investors 10%. Let's say I raise $1 million, and it takes me 18 months to turn a deal. If I borrow $1 million from my investors, I can pay them $100,000 in year one and $50,000 in year two until this thing stabilizes and I refinance it and give them all their money back. So it's very predictable for me that I just need to make sure I build in $150,000 of interest reserve, pref reserve, you can call it whatever you want, into the deal. That allows me to then make payments to my investors every single quarter, so that way they see money coming in. They like that because all of a sudden, 90 days after they made the investment, wow, this thing works, right? So now it's more confident in Tim, more confident in the team, less questions I get from it. And, again, because it's distressed, it's tax advantage also because the pref isn't coming from cash flows. Now it's been reclassified into long-term capital gains. It's taxed whenever the property sells. And anyways, that overly complicates things. But what's beneficial for me and our joint venture operating partners, or the other GPs, is that we've taken the syndication equity split and totally flipped it on its head. So we usually keep 70 to 80% of the equity as the GPs. The investors get 20 to 30% of the equity. And you might think, dude, that's not a good deal. Like, these investors are getting screwed. Well, are they? If they're making a double-digit return on their money, predictable, backed by a premium asset, and then they get all their money back in 18 months. So now they get their money back in 18 months. They made 10% on their money annualized, which is super respectable. And then they keep 20% of the equity in the deal forever. So they have 20% of depreciation. They get 20% of appreciation. They get 20% of cash flows. They get 20% of refi proceeds. They get 20% of any future sales proceeds. There's a lot, and that's infinite return on their investment. Not only that, but they're in one deal for, let's call it 24 months. There's velocity on their capital where now they can get involved in 3 to 5 deals in that same 5 to 10 year term as they would in one traditional syndication. So it's not better, it's just different. It's different on a per deal basis. If I was buying something that was stabilized and it was a primo asset in a great location, and I can get it at a little bit of a discount, but maybe not 65 cents on the dollar, but maybe 80, 85 cents on the dollar, I would traditionally syndicate that. But if I couldn't, or if it's a premium asset and a premium location and it's totally stabilized and totally renovated, it's hard to find deep discounts on those kinds of deals. So most of the deals we just go in. My portfolio, I told you before we started, is it's $325 million of assets. I just did the numbers because I closed on a new deal yesterday. We're at 63.73% of total all-in price per stabilized value. So, so if you take a look at, and that's across my entire portfolio, that includes debt and investor equity. So we've been able to build a portfolio with a lot of spread in there, just based on how we buy properties and the amount of work. Like, we're creating that as the operating partners, right? Like, know how much work it is. We put into these things, especially heavy value adds. And I think it's only fair that a little bit more of the equity is carved up for the GPs in that position. And listen, man, I've talked to a lot of equity investors who are used to traditional syndication, and they don't like it. And it's just like, I'm not going to do that on sheer principle. I would never invest with you, Tim. Totally understand. And then other people are like, I totally get it. I love how interests are aligned, because I don't fee deals either. Like, occasionally I take an acquisition fee on about 1/3 of the properties I buy. And I'll take any acquisition, any asset management, fundraising, any of these other things. So my payday comes from refi proceeds and cash flow thereafter. So my investors are getting paid regardless of the property's performance. I only get paid once the property pays back the investors, and that's when Tim and team get paid. So now all of a sudden we're in the same boat, rowing in the same direction, versus some traditional syndications. It's a little bit different. Like sometimes, if the deal's performing or not performing, sometimes the GP gets a fee. If the deal's not performing, the investor doesn't make any money. So it's just, again, it depends on the deal, depends on the structure, depends on how good of a deal it is, where it is, a lot of different things. So there's different structures for different deals, and that's just what I've kind of fallen into. And candidly, it's tough for me to raise money on a traditional syndication because my investors are used to getting their money back every 24 months now and cycling it that way. So I've kind of, shot myself in the foot on this thing.
You've kind of niched yourself though too. I mean, you've got a unique offering that a lot of people don't necessarily have anywhere else where they can go and get that same type of thing. Or, there's hundreds of syndicators that, pretty well all operate the same way. So that's unique. So go ahead.
And it boils down to two things. You got to get really good at finding off-market direct-to-seller deals, and you got to be a badass at project management. Because if you're not good at construction and things go long, things go over budget, the whole thing can blow up in your face. So if you're like, you got to be really, really, you have those two things dialed in really, really well. Yeah. And then it makes a lot of sense, So I've also been in other ones that have gone long, and all of a sudden it gets a little bit messy. So making sure that due diligence is dialed in, making sure that, whoever's overseeing project management knows what the heck they're doing. Management company knows what the heck they're doing and how to reposition assets and rebrand them and remarket them. It's important stuff because it's very, very management intensive.
Yeah, absolutely. So talk a little bit about how you manage that construction project. What types of tools do you use? What types of systems do you have in place? And I know that you have a team as well that helps on that, but can you talk a little bit about those types of things?
Yeah. So my team is rock stars. Like I think, like my vision and my goals, my greatest skill set, I would say, it'd be painting a vision to people to attract A players to my team, even if I can't compensate them what they're worth today. And I've been able to attract some rock star individuals on my team that I've just kind of painted a vision for 5 years, 10 years down the road. And now we're hitting stride in that. And so, I've given them equity and profit share in my different deals. So that way they saw the long-term goals and the visions, and it's been huge for them. So I've been able to attract some stars, and they handle a lot of the operations. I found that I'm really good at certain things, and I create chaos in other elements of the business, So I'm good at marketing. I'm good at social media. I'm good at raising private money. What I'm not good at is standard operating procedures. I mean, I've done it, and I did it in residential for a long time. But the reason it was always chaotic is because I was in charge of it. I'm always the bottleneck in that side of things. So I found somebody who complemented my skill set really, really well and brought them into my organization. So my COO, his name's Matt Carlin, is a rock star. And he's built out all sorts of standard operating procedures, checklists, and he's the systems guy. So we use something called Monday.com, which is a workflow management system. There's a lot of different ones that are out there. Asana's out there, and a bunch of different ones that are out there. But he likes that one. It's very user-friendly. It's user-friendly not only for the people who like the standard operating procedures and the structure, but it's user-friendly for my acquisitions guy who is not that kind of structured type individual, and he can easily navigate the
interface.
Monday.com interface. So that's what we use, and I can tell you that I've logged into it one time in 2 years since we implemented it, or 2.5 years since we implemented it. So the good news is I got a great team in place, and they know how to do all of it, and I can stay focused on what I do, and it makes their job easier because I'm able to source deal flow. I'm more able to source investor capital and do all those kinds of things, which just make their life easier to focus on what they're really, really good at.
Yeah. So speaking of sourcing deal flow, where do you invest, or how do you select the locations where you invest in multifamily opportunities?
Yeah, most of the opportunities that we come across are usually in. So first of all, I do a little bit of education stuff. I kind of fell into it when I was talking about some multifamily deals, as I'm sure you do. Like people
Hmm.
hit you up and say, "Hey, do you consult? Do you coach? Can I pay you to mentor me?" And I turn that into kind of like a coaching program where I do, a live event like once a quarter for the past few years. And I've had anywhere from 100 to 200 people come out to that, and I just kind of teach them how to go out and find deals the way that we do. And so we source deals the same way that I did in the residential world. So in the residential, they teach you how to go out and find off-market direct to seller deals by, cold calling, by outbound voicemail, text messages, direct dialing, driving for dollars, direct mail, um, networking at real estate investors associations and landlord associations and mastermind events and all these different things. We do the same thing with multifamily, right?
Hmm.
Like just like there's houses with tall grass and boarded up windows, there's apartment buildings with tall grass and boarded up windows. And so you can go to the building department and find out which buildings have any sort of violations on them,
Hmm.
and reach out to those building owners. You can look up delinquent taxes. You can look up Google reviews is a great one. Just Google search Cleveland, Ohio apartment buildings, see what pops up. Look for the ones with the worst reviews. Chances are they're not being taken care of. They got bad management in place. They got angry tenants. The city's on their ass. So there's a lot of different things that you can do to be creative. Go hang out. You know what's going to be a good one? Hanging out at eviction court. As soon as they open up these moratoriums, there's going to be a lot of motivated landlords hanging out there, management companies and attorneys that represent motivated landlords as well. So go and hang out, rub elbows, pass out a business card, meet people, and tell them that you're looking to buy apartment buildings. So we do that. I've taught all my students how to do that. And what's happened is I've created a lot of bird dogs where they're going out doing all these things in their municipalities, their communities, and then they're bringing in the deals to me that they can't qualify for. So they don't have the money, they don't have the balance sheet. They need somebody to just kind of look over their shoulder and hold their hand. And they bring those to me. And now all of a sudden they can get into a deal that they couldn't get into. I can get into a deal that I wouldn't have gotten into. And all of a sudden we both build wealth and make money. So it's worked out really, really well. And that's how we've sourced a lot of projects. So a lot of our stuff happens to come into the southeastern portion of the United States. I know you're heavy in Atlanta area. Majority of my portfolio is in Georgia, South Carolina. I got some stuff in Alabama, North Carolina, Florida. Where else? Louisiana just closed on a deal yesterday.
Yeah,
so,
I saw that.
Yeah, so we have heavy in the Southeast. I also own some stuff in Texas and Oklahoma, and then some stuff obviously in Cleveland and throughout the Midwest too. So most of the stuff that we come across is in secondary and tertiary kind of cities. They might be flat. I don't really look that much into is the city growing or is it dying? We look a little bit at that, but really we look at, what's the median income in the area, in the immediate vicinity. And I want to make sure that I'm going to have the nicest building at market rate rents. If I have the nicest building in the area at market rate rents, I know all the quality tenants are going to move into my property. And so all of a sudden I attract the best tenants in the area because there's always going to be, like, I live in, Charleston, South Carolina. Now, Charleston as a whole is growing. The island that I live on is totally capped out. And it's been steady, capped out for the past 20 years. So it's not growing, but it's also not dying. And so it's just stagnant. Does that mean it's not an A-class area? I mean, I'm surrounded by, there's I don't know, more houses on the island worth over $3 million than under $3 million. You know what I mean? So it's an amazing community. It's an A-class area, but it doesn't meet the demographics that some people look for in certain municipalities to go and invest in. So would you not invest here? No, I'll still invest here, even if it's got flat, growth. So I don't pay that much attention to that. Again, I look more on a micro level of, can I have the nicest building at market rate rents? I don't try to charge a premium. I just want the best building, the nicest finishes, the nicest amenities to attract the highest quality tenants into that building at the same rent that they would pay for a not as nice and not as many amenity type property across the street. And that allows me to stay occupied, allows me to stay steady and predictable in my maintenance schedules and everything else that comes with it.
And plus you're acquiring these things at such a good cost basis too, that, it's difficult to not not make money there. You mentioned before that you want the average income to be a certain level. What is the threshold that you look for in the areas that you're looking at for that average income?
Yeah, so we usually invest in workforce kind of B and A minus class housing. So B minus is like the lowest we'll go. We try to stick to that B plus kind of an area. And when I rate it, I'm rating it area. I'm not rating the building, right? Like I want the ugliest house on the best block. I want the worst building in the best neighborhood. That's where you get the appreciation that jumps in. So we're usually looking for somewhere in that $50,000 range.
Okay.
The building we just bought has a median income of $75,000 in an area that's flat, but it's $75,000 median household income within 5 miles. And so you're like, man, there's some serious cash in this area, and there's jobs, and it's steady. It's just not growing.
Yeah. No, that makes sense. I went to one of your events in, I think it was Orlando, January, I think of 2019, if I remember correctly. At any rate, you made mention of a buyer is a seller, is a investor, just depending where they are in the life cycle. And that really struck me. I think that absolutely makes total and complete sense. So talk about how you go about networking with, people that you may or may not ever do business with. Do you have any strategies or techniques to, reach out and connect with other people that you may think might be an owner, investor, seller, again, depending where they are in their life cycle?
Yeah, I think that's a great question. And hitting on that point, like, look at me. We were talking before this, is like, I am a net buyer of real estate. However, I'm selling a $75 million portfolio right now. 1,300 units are going out the door. All my like C plus, that kind of got me to where I am. I plan on selling. And so I'm buying real estate, I'm selling real estate, and I passively invest in real estate. I just, I had my own investment fund where I then go and deploy money into deals with great operators. And so I'm doing all three of those things at one time. Some people are only doing one at one time or two of them at one time. But if you're a buyer, you're eventually going to be a seller, or and if you're a seller, you're eventually going to be a private money lender, right? Like you've tasted residual income and passive income. So I try to build all three of those funnels. I try to build a funnel of investors. I try to build a funnel and attract investors. Maybe that's through social media. Maybe I'm talking about a deal and I'm talking about what the investor returns look like on a past deal, right? Like you can't project returns or try to guarantee, but you can talk about doing a case study on a past deal a lot of times, as long as it's packaged the right way. And you can attract investors that way. You can, if I'm looking for people who are looking to buy apartment buildings, I'm telling them that I'm looking to sell. And all of a sudden, hey, if you're interested in buying an apartment building, I got XYZ for sale. Send me your contact information and I'll send you over a package. Now I'm getting their information. They have money, obviously. Even if they don't buy my package, I know that they have money. Maybe I can turn them into a private money lender, and maybe they'd like to be passive instead of active. And same thing with sellers. If I know that somebody's selling, I've raised money from some people at the closing table saying, hey, what are you doing with all this cash that you're about to get? I don't really know. It's going to sit in my bank account. Why don't you lend it back to me at 11% interest only? Oh, that's a pretty good deal. Okay, I'm in. So I'm just talking about it, right? And I think it's kind of cliche to say, but you just add value. You add value to people. You add value in educating them. Like you're adding a ton of value to your followers and your listeners by having this podcast, by bringing on guests and sharing knowledge about how to build wealth and how to build lifestyle and tax advantages and all those different amazing things. You are going to, derive private money and deal flow and all those different things from having your own podcast. So I do the same thing. I just do it through social media. I'm not really good with the tech stuff. And so it's just easy for me to pick up my phone and just go live on Facebook.
Yeah.
And it gets shot out to everybody. And then eventually they follow me or they share it, they like it or whatever. I've also been very intentional about who am I friends with on Facebook. I've had a lot of people that were, buddies in high school and college and, or people that I never really knew. And, I just trying to I was friends with them. And then all of a sudden it turned into like, if you have any negativity, if you don't take personal responsibility, if you are in a dead end job and you blame everybody else, I defriend them, right?
Yeah.
They're not on the same path as what I'm going on.
Yep.
So I'm very intentional about friending up real estate investors, real estate entrepreneurs, and entrepreneurs that are not in real estate. Why? Because real estate entrepreneurs are going to bring deal flow. People who are involved in real estate, wholesaling real estate, flipping real estate, they're going to be able to source deals and send them to me. And then entrepreneurs who are not involved in real estate, they have money. They're really good at making money. They're very bad at deploying it. They're most entrepreneurs that I know that are not real estate investors are very poor at deploying their capital into assets to generate more income. So they can launch a product, they can sell their business, they can start another business, they can go public, and they're really good at making a lot of money, but then they have no idea what to do with it. So they see my posts over and over and over again talking about how to invest in real estate, and you build a relationship, whether they've ever reached out to me or not. We live in a voyeurism society where people are just looking at what we're doing. They might not be commenting, they might not be liking, but they're seeing it, and they see it on Facebook. And it's free to have 5,000 friends. So I went through Facebook and I friended up entrepreneurs and I friended up real estate professionals. And that's most of who I'm connected with on social media. A lot of my students, I'm friends with on social media as well. And so I just try to connect with those kinds of people because we're going in the same direction, right? Like I want people on the train, who are going down the same path as me. And if I'm not saying anything, there's nothing bad about people. They're great, amazing human beings, but they were on the train ride for a few stops, right? And then they got off, and they have no intent of getting back on the same train that I'm on. Yep. And so I'll still be friends with them, still buy them a beer, hang out, and whatever. But I use social media as a tool, and a tool creates leverage. It makes your job easier. I try not to consume on social media unless it's somebody that I really look up to and a mentor to me. But I do create on social media. I'm always creating content that will source deals and will source money. If you're doing those two things, man, you're in really good position in real estate.
Yeah, no, that's great. That's great. And one of the other great things about you too is, obviously you're a very, very motivated and driven person, but you're also very connected with your family, and very much so, set time aside for your family. So congrats on being able to make that, make that delineation, because I know that's difficult for myself and many other.
You got to be intentional about it, man.
Yeah.
Yeah. You just got to, like, we time block. I'm time blocking for you. I'm not going to take a phone call or, why do we do that for business, but we don't do it for our family? And I messed up bad when my daughter was 2 years old and she asked me to go play with her. And I said, let me send this text message. And then she went and started playing by herself. And I'm like, what? I finished this text message. I'm like, what the hell am I doing? Like, what am I thinking? Whether she knows it or not, I'm planting a seed in the back of her head that, the number one man in her life that she comes to for love and appreciation and affection and support and consolation, like all of a sudden I'm planting a seed of disappointment, of being ignored. And then all of a sudden she grows up and she thinks that's what love is, and she starts dating some jerks. And then she starts getting into poor relationships, and it's my fault, right? So I became very intentional about making sure that I time block time for the family in the evenings. We're always like, I don't do podcasts in the evening, right? That's why I book all my podcasts in the middle of the day. And I make it very intentional where I don't book anything on Friday, Saturday, Sunday, Monday. And those are just me days. And then I do all my podcasts Tuesday, Wednesday, Thursdays, or,
love it.
Work type stuff.
Yeah, love it. No, and we're right up on time here, Tim. This has been fantastic. If people want to learn more about you or any of your programs or anything, what would you say is the best way to get in touch with you?
Yeah, I appreciate that, man. Just hit me up on Facebook. I'm most active on Facebook at Tim Bratz, or at TL Bratz is my Facebook. I'm also on Instagram at Tim Bratz. And just shoot me a message. I personally respond to all those messages. And if there's anything that I can help anybody with, there were people that had their hand out and lifted me up and helped me up. So I always try to give back as much as I possibly can on social media. And so, those are the best ways to connect with me.
Love it. Love it. Tim, this is fantastic. I appreciate the time, and good luck on the next ventures, and hopefully we'll do some business here someday together.
Looking forward to it, bud. Thank you for everything that you do.
No problem. No problem. Thanks, Tim.